Are you looking to retire abroad or maybe even spend some time abroad in retirement? Well, this video is for you. We're going to cover off many things in this video that you need to think about as you look to retire abroad or spend time outside of Canada in retirement. Now, we're going to cover some tax issues as well as some personal checklist issues that you're going to want to think about. And this is based off 20 years in the business, working with clients that have transitioned out of Canada for retirement, doing retirement plans for them. There's a lot that goes into this, and a lot of you are missing things that are going to cost you a lot of tax money. So let's jump into it. The very first and the biggest thing, to be honest, is departure tax, or exit tax as some people call it. And that is really when you leave Canada. So when you became a non-resident of Canada, there's this thing called departure tax. And departure tax basically is, look, when you leave, we assume that you've disposed of all of your assets other than registered investment accounts. Basically everything else is deregistered, liquidated, and taxed. Now, departure tax can catch a lot of people off guard. I've talked to many of you that have left Canada and have realized later that, oh shoot, I still have my principal residence, I still have assets, a business, whatever it is. And CRA loves that because they get a really nice check for you. So make sure you understand what departure tax is and how it's going to affect you if you leave Canada. Again, assume all your assets are disposed of. That's the reality when you leave Canada. Now, there are some excluded properties in this departure tax. Your principal residence could possibly be one of them. And also registered investment accounts, like I mentioned before, as well as pension plans and government benefits. Now, when we talk about departure tax, it's really important to talk to a cross-border tax accountant. This is somebody, an accountant, typically a CPA here in Canada, that deals with cross-border tax issues. This is a specialty that not everyone will deal with. So if you're thinking about, retiring, I talked to someone yesterday, retiring to the Dominican Republic. Perfect, that's great. You're leaving Canada, you're gonna move there full time. There's a big tax issue here. There's things you need to do before you leave Canada, departure tax being a big part of it. Understand how it's going to affect you, things you need to do before you leave. So make sure you have a great cross-border tax accountant on your side to figure out the tax nuances of making the move out of Canada. The second thing you need to think about and look into is residency status. So if you become a non-resident of Canada, you have to sever your ties with Canada. Now, that could happen through a natural severing of your ties and actually making a declaration of that, or it could be just spending more time outside of Canada and actually attaching yourself to another country from a tax standpoint. When you establish significant ties to another country, that by default attaches you to them and disconnects you from Canada. And that could be something that actually creates a non-residency issue for you that you're not even aware of. So again, this is always why you want to be careful of what is your intention, how much time are you spending abroad, and understand the consequences of it. Again, this video is all about things that you need to be thinking about because a lot of you are being caught with your pants down. It's a tough situation. It's an expensive situation. So really understand if you're spending time outside of Canada on purpose or not, you want to understand what the consequence could be for you. The third thing you need to think about is your ongoing tax obligations and tax filing obligations. Even though you become a non-resident of Canada, you may still have to file a tax return here in Canada. If you have Canadian source income, pension plans, rental income here in Canada, there may be a requirement. Again, talk to that cross-border tax accountant to see what your requirement is going to be based on your unique situation. But just because you're a non-resident of Canada doesn't mean that you've gotten away with not having to file a Canadian tax return. Now, if you become a non-resident of Canada, you may have no tax filing requirements here in Canada, but that doesn't mean you're not paying tax to CRA still, because there is a 25% withholding tax on pensions, CPP, old age security. Any source income out of Canada here will have that 25% withholding tax. Now, Canada has tax treaties, which I'll touch on here in a second, with many countries that will help alleviate that 25% down to 15% for some types of income. But again, if you have income coming out of Canada, expect to pay 15 to 25% withholding tax on average to Canada. And this is why I always say, and this catches people off guard often, is that retiring abroad isn't necessarily cheaper from a tax perspective. You actually might make larger tax payments to CRA and wherever you're living. But wherever you're going to will be hopefully a lower cost of living and a place where you want to be. So yes, you're paying more tax, but your money goes a lot further wherever you're going. Thus, you can enjoy retirement a little bit better. Whether that's Mexico, Philippines, Dominican Republic, there's many countries, Portugal. Clients are going all over the place. Let me tell you, I talk to people every day that are going somewhere outside of Canada, and it varies. And again, this withholding tax is going to be different, depends on what type of income, how you're drawing it out. There's a lot of factors here. So again, talk to your accountant and work with your financial planner to put a plan in place to see, look, if I move abroad, what happens to my Canadian source of income? What's the withholding tax? Am I actually going to pay more tax than if I just stayed here in Canada? The fourth piece is pensions and retirement income that you have here in Canada. So if you leave Canada and you have RSPs, LIRAs, a pension plan, your CPP, your old age security. Again, these are income sources out of Canada. They'll have 25% withholding tax, could be down to 15 depending on where you go and what type of income and how you structure it. But expect 25% and hopefully it's lower. Again, structure is a big thing here. But you want to make sure that you understand how this comes. When you leave Canada, do you get your CPP and OAS? Likely you do. We have a video on that. We'll click that above. If you're wondering, like, if I leave Canada, do I continue to collect my CPP? Do I get old age security? Was I in Canada long enough? Watch this video above and it'll detail all of that for you. As mentioned earlier, tax treaties. Canada has tax treaties with many countries, most countries. And what a tax treaty does is make sure there's not a double taxation on income. So let's say you have RSP here in Canada, you start drawing RIF income, there'll be a withholding tax. You don't double pay on your income wherever you're going to if there's a tax treaty. So it helps avoid the double tax. Now, again, if you have a, let's say 25% withholding tax in Canada, and it's a lower tax rate wherever you're going to, it doesn't mean you're going to get that money back. In fact, you typically don't get that money back. So that's why a lot of you leaving Canada will actually pay more in tax to CRA than you would if you just stayed in Canada. But again, your dollar's going much further, and I know there's other reasons to leave to other countries, primarily wintertime. It's cold here in Canada no matter where you go, and it's a lot warmer elsewhere. So there's many reasons to leave, but just be aware the tax situation and how much you pay CRA shouldn't be a deciding factor because it's likely that you'll actually pay more to CRA if you retire abroad. When it comes to your principal residence, you want to understand how this is going to work if you sell your principal residence after you become a non-resident or after you leave Canada. It can be quite punitive. Again, talk to that cross-border tax accountant to make sure you understand what you need to do before you leave. And that's my stress of this video. If you are someone that's even contemplating retiring outside of Canada full-time or even part-time, you need to understand how this works. And a lot of you are just winging it. You need to do your research. It's quite complicated, and a good cross-border tax accountant will help you. Again, we'll list a couple below for you that do cross-border tax accountant work. Again, typically how our office comes in with the financial planning side of it is the accountant will look after the departure tax and structure and tax nuances and that, and tax treaties and all that. Where our office comes in and says, look, Joe and Sally, if you retire to Portugal, here's your income sources that you'd have here, like the withholding tax, and we can map out like how much tax is going to be withheld, how much is going to come into your pocket, so you know what you're actually going to have to live in Portugal. And again, we've done many plans where a client says, look, we're not sure if we're going to stay in Canada or go abroad. And we'll look at just a base scenario of, here's Canada, here's where you're looking to go to. There might actually be a larger tax bill, but sure, you have less in your pocket by $500 a month over here, but housing, food, everything's a lot cheaper over here. So your dollar's going to go a lot further, and you can help make that financial and psychological decision around where you want to retire to. So my red flag for all of you looking to retire outside of Canada or spend time outside of Canada, do your research, understand departure tax, tax treaties, how much tax you're going to pay, withholding taxes. Right? What happens to your property principal residences? If you have a company in Canada, it becomes that much more complicated. There's a lot of moving parts if you plan to leave Canada, become a non-resident, or just spend a lot of time abroad. Don't get caught offside. Make sure you understand what's going on. And these are just some of the pieces you need to think about. Again, there's other aspects to this like healthcare. Right? When you become a non-resident, you lose Canadian healthcare. Now you may be moving to a country that has great, cheap healthcare that you pay out of pocket. That's great. Again, these are things you need to think about. Start mapping this out internally, talk to your financial planner, talk to your tax accountant, and make sure you have all your ducks in order before you pull the trigger on any of these things. So thanks so much for joining us. Again, if you need to learn about leaving and collecting CPP-OAS, watch this video above. It's really key to make sure you understand, will you collect your government pensions if you leave Canada? Potentially yes, potentially no. That video has it. Check it out.